Alert. Silver price just collapsed. Not a dip, not a correction, a collapse. And the rally everyone was counting on, it might already be over. But here's the part that no one is talking about. The real reason behind this massive drop is not what you think. And what is coming next could change everything for those who are watching closely. Stay right here, because what we are about to reveal, you cannot afford to miss. Welcome back to John Analyst. Now, if you have been watching this channel for a while, you already know we do not waste your time here. This is not entertainment, this is intelligence. And today's intelligence is one of the most important we have ever delivered. Now, before we go any further, if this is the first time you are sitting here with us, do us a favor. Think of it this way. You have spent decades building something valuable. Your knowledge, your experience, your instincts, so protect them. Hit that subscribe button and make sure not a single important update slips past you. Now, we want to know something. Drop a comment right now and tell us from which city, from which country are you watching this today? Because we want to know exactly who is paying attention. Now, let us get into what actually happened and why it matters more than anyone is admitting. The markets closed on Friday with a silence that felt almost rehearsed. No dramatic headlines, no breaking alerts across the major financial networks. And yet, something had already shifted. Something that most investors, most analysts, and most financial commentators had not yet fully processed. Silver had just experienced one of the sharpest single-session declines in recent memory. Not a wobble, not a routine pullback that traders brush off over the weekend. This was a collapse. And the speed at which it happened, that is the part that should have every serious decision-maker paying attention right now. Let us start with the numbers, because the numbers do not lie. Silver had been trading at levels that felt almost electric in recent weeks. The momentum was there. The sentiment was there. Investors who had been watching this market for years, they were leaning forward. They were positioning. They were expecting continuation. And then, in a matter of hours, silver snapped lower, hard. The kind of move that does not simply erase gains. It destroys confidence. Silver dropped into the neighborhood of $80, a level that just days before had not even been part of the conversation on the downside. Gold was not spared either. But here is the critical detail that separates those who will understand this moment from those who will simply react to it. Silver did not fall because of silver. Silver fell because of the structure. Let us forget the headlines for a moment. Forget the opinions. Forget the emotional reactions. And instead, let us look at what actually moved this market. Not why someone believes it moved, what actually caused it. Because there is a difference, a massive difference. And understanding that difference is what separates strategic thinking from emotional reaction. To understand what happened on Friday, one must first understand what was already in motion. The precious metals market does not move in isolation. It moves within a system, a mechanical system of leverage, positioning, and expectation. And in the days leading up to this collapse, that system had been quietly tightening. Traders had been positioned for a very specific narrative. Easier monetary policy, faster rate cuts, a weaker dollar, the kind of environment where silver does not just climb, it accelerates. That positioning was not wrong in its logic, but positioning built on expectation is always vulnerable. And on Friday, the expectation changed. The trigger came from a single headline. A new name floated for the next Federal Reserve chair. One name, one article, one moment. And the entire repricing began. Markets do not wait for confirmation. Markets do not wait for policy meetings or official statements. They reprice instantly, based on what traders believe might happen next. And what traders believed on Friday was that the path toward easier money had just gotten longer. Not impossible, not eliminated, but delayed. And in a market built on the speed of that timeline, even a small delay can feel like a wall. What followed was not panic in the traditional sense. It was mechanical. Margin calls triggered first. When prices drop fast enough, brokers do not send polite emails. They liquidate automatically, immediately, without hesitation. Those forced sales pushed prices lower, which triggered more margin calls, which triggered more liquidation. This is what traders refer to as an air pocket, a zone where there are no buyers willing to catch the fall. And the sellers are not selling because they want to. They are selling because the system is forcing them to. Silver fell faster than gold for a reason that is entirely predictable. Silver is a thinner market. It has less liquidity, less institutional depth. When the move begins, silver does not resist it. Gold is a cruise ship. Silver is a speedboat. When the wind shifts, the speedboat does not rock gently, it flips. By the time the dust settled on Friday evening, the gold to silver ratio had stretched back above 60 to 1. meaning it now takes more than 60 ounces of silver to purchase a single ounce of gold. That ratio is a signal, not a prediction, a signal. It tells us that silver absorbed a disproportionate amount of the damage. And historically, when that ratio stretches to these levels after a sharp move, what happens next is never simple. The collapse is now behind us. But the story, the real story, is just beginning. Everyone has an opinion right now. The forums are loud. The social media feeds are full. Every second commentator has a theory. But here is the uncomfortable truth. Most of them are looking at the wrong thing. They are staring at the price. The price is just the result. The real story is buried in the mechanics, and the mechanics tell a very different story than what most people are hearing. Let us forget the headlines for a moment, forget the opinions, forget the emotional reactions, and instead, let us look at what actually moved this market, not why someone believes it moved, what actually caused it, because there is a difference, a massive difference. And understanding that difference is what separates strategic thinking from emotional reaction. The first thing to understand is that silver did not collapse because silver was weak. Silver collapsed because the environment it was sitting in suddenly changed. Think of it this way. Silver had been climbing inside a very specific set of conditions, conditions that were built on a single powerful expectation. That expectation was this: the Federal Reserve was going to cut rates, not eventually, soon, aggressively. And traders had positioned themselves accordingly, billions of dollars sitting in markets, waiting for that exact moment to arrive. Silver was one of the biggest beneficiaries of that positioning, because silver does not just respond to monetary policy, it amplifies it. Now, here's where it gets interesting. On Friday, a single piece of information entered the market, a name. A potential new Federal Reserve chair was floated, one name, and within hours, the entire calculation changed, not because the rate cuts disappeared, not because the economy suddenly became stronger, but because the market decided that the timeline had shifted, that whoever sits in that chair next might not move as fast as traders were expecting. And in a market built entirely on speed, even a small shift in timeline can unravel months of positioning in a single session. This is where most commentators get it wrong. They blame manipulation. They blame the institutions. They blame the system. And perhaps some of that is not entirely without basis. But the mechanical reality is far more precise than any conspiracy. Here's what actually happened. When the market repriced the Fed chair narrative, the dollar strengthened, because a less dovish Federal Reserve means tighter monetary conditions, which means the dollar becomes more attractive to global capital. At the same time, bond yields moved higher. Higher yields mean that holding assets like gold and silver, which produce no income, becomes relatively less appealing. Dollar up, yields up, silver down. Not because someone decided to crush silver, because the plumbing of the market did exactly what it was designed to do. And then came the second wave, the margin calls. This is the part that accelerates everything. When silver began dropping under the initial repricing, leveraged positions started hitting their limits. Brokers do not negotiate, they do not send warnings. They liquidate immediately. And every forced liquidation pushed the price lower, which triggered the next round of margin calls, which triggered the next round of liquidation. This is not a theory. This is a mechanical process. It has happened before. It will happen again. And it is happening right now, in real time, inside this very market. The gold to silver ratio stretching back above 60 to 1 is not a coincidence. It is confirmation. Confirmation that silver absorbed the damage disproportionately. Confirmation that the leveraged positioning in silver was far deeper than most retail investors understood. Confirmation that the mechanical unwind was not random. It was sequential. First, the expectation shifted. Then the dollar responded. Then the yields moved. Then the margin calls began. And silver, being the thinnest, the most leveraged, the most emotion-driven of the two, fell first and fell hardest. So the question now is not whether the market was manipulated. The question is, what does the mechanical reality tell us about what comes next? Because the plumbing does not lie. And right now, the plumbing is saying something very specific, something that part 3 will break down completely. Close your eyes for a moment. Forget everything you have read this weekend. Forget the headlines, forget the opinions, forget the noise. Now, open them again. And this time, look only at the data, because the data has been whispering something for weeks now. And on Friday, it finally started screaming. Most investors never hear it, not because they are not intelligent, not because they do not care, but because they are listening to the wrong frequency. They are tuned into sentiment, into opinion, into what other people are saying. And sentiment is always the last thing to update. The data updates first, always. Let us start with something that very few people are discussing right now, the COMEX. For those who are not familiar, the COMEX is where futures contracts for gold and silver are settled in the United States. It is the backbone of the paper market. And the paper market is where prices are actually determined, not in the physical world, in the paper world. This distinction is not a footnote. It is the entire story. In the weeks leading up to Friday's collapse, something unusual was happening inside the COMEX. Inventory levels were shifting, not dramatically, not in a way that would make headlines, but consistently, quietly. The kind of movement that only surfaces when someone is actually looking at the underlying delivery data, rather than simply watching the price tick up and down on a screen. Registered inventory, the silver that is actually available for delivery against futures contracts, had been declining. Slowly at first, then with increasing frequency. And here's what that tells us. It tells us that the physical market and the paper market were not moving in the same direction. The paper market was pricing silver higher. The physical market was quietly tightening. Two markets, two realities, running side by side. And on Friday, they collided. Now let us look at institutional positioning, because institutions do not think the way retail investors think. They do not react to headlines. They anticipate them. And in the weeks before this collapse, the positioning data was telling a story that most people simply ignored. Large traders, the ones with the deepest pockets and the sharpest information, had been reducing their net long positions in silver, not all at once, not in a way that would trigger alerts, quietly, methodically. The kind of reduction that only becomes visible when you study the commitment of traders' report, with the same discipline that a surgeon studies an X-ray before making a single cut. They were not abandoning silver. They were trimming. And trimming, in institutional language, is not a warning. It is a preparation. But here is where the data gets truly interesting. Because while institutions were trimming on the paper side, something entirely different was happening on the physical side. Dealers were reporting longer wait times, premiums on physical silver, and the actual metals were not behaving the way they should behave during a market that was supposedly still in a rally. Physical premiums should compress when prices are strong. They were not compressing, they were holding. In some cases, they were expanding. And that divergence between what the paper market was saying and what the physical market was demanding is a signal that serious decision makers do not ignore. Now let us bring in the historical pattern. Because this type of move, this speed, this severity, this mechanical structure, it has a fingerprint. And that fingerprint has appeared before, not once, multiple times. And every single time it has appeared, the phase that followed was not what the headlines predicted. It was not a continuation of the collapse. It was not a slow, grinding recovery. It was something sharper, something more sudden, something that rewarded only those who were watching the data and punished everyone who was watching the sentiment. The ratio stretched, the inventory tightened, the institutions trimmed quietly. And then the next move began, not with noise, with precision. This is not speculation. This is not opinion. This is pattern recognition built on verified data. And the data right now is aligning in a way that has not been seen in a very long time. What that alignment means for those who are serious about protecting and growing their wealth is exactly what Part 4 will lay out, clearly, completely, and without compromise. You have made it this far, and that alone tells us something about you, because most people would have stopped watching by now. They would have seen the red candles, read one opinion on social media, and moved on with their weekend. But you did not. And that decision, to keep watching, to keep listening, is exactly the kind of decision that separates those who build wealth from those who simply watch others do it. So let us not waste this moment. Let us talk about what actually matters now, not what happened. We have already covered that. What matters now is what comes next, and how serious decision makers should be thinking about it. First, let us be completely honest about something. Nobody can predict the market with certainty. Anyone who claims otherwise is either selling something or has never actually been tested by the market. But here's what we can do. We can read the structure, we can study the data, we can identify the conditions, and then we can build a framework, not a prediction, a framework. And frameworks are what serious money uses every single time. The first condition to watch is the gold to silver ratio. Right now it is sitting above 60 to 1. And historically, every single time this ratio has stretched to these levels after a sharp mechanical sell-off, it has eventually compressed. Not immediately, not in a straight line, but it has compressed. The compression of this ratio means silver moves faster than gold on the way back up. Not because of sentiment, not because of headlines, because of mathematics. If gold holds its current level and the ratio simply returns to where it was trading just weeks before this collapse, the percentage move in silver would be significant. This is not speculation, this is arithmetic. The second condition to watch is the Fed. Not the headlines about the Fed, the actual decisions, the actual language, the actual policy moves, because here is the reality. The trigger that caused this collapse was not a policy change. It was a perception change. And perceptions can shift back just as quickly as they shifted forward. If the new Fed chair signals even a slightly more dovish tone, if the economic data begins softening, if inflation continues its downward trajectory, the entire repricing that happened on Friday could reverse. Not partially, completely. And silver, being the speedboat that it is, it would be the first to move. The third condition, and this one is critical, is the physical market. Because while the paper market was collapsing on Friday, the physical market was doing something very different. It was tightening. And physical tightness does not disappear because a futures contract repriced. The metal is either there or it is not. And right now, the data suggests it is becoming increasingly difficult to source. That divergence between paper and physical is not sustainable indefinitely. Eventually, one of them adjusts to match the other. And historically, it is the paper market that adjusts, not the other way around. So what does this mean for the serious decision maker sitting here right now? It means this moment, this exact moment, is not a moment for panic. It is not a moment for emotional selling. And it is certainly not a moment to simply walk away and assume the story is finished, because the story is not finished. The story is entering its most critical phase. But it also means this is not a moment for blind aggression. The market just demonstrated, in the most brutal way possible, exactly how fast leverage can destroy positioning. Anyone who was carrying too much risk on Friday learned that lesson the hardest way, and that lesson should inform every single decision made from this point forward. The framework is simple. Watch the ratio, watch the Fed, watch the physical market, not one of them, all three. Because when all three align, that is when the next real move begins. And when it does, it will not announce itself gently. This is John Analyst, and we will be here watching the data, reading the structure, and bringing you the intelligence you need before the market makes its next move. If today's analysis was valuable to you, share it with someone who needs to hear it, someone who is serious, someone who is paying attention, and remember, drop a comment below, tell us where you're watching from, and tell us, are you watching the ratio right now, or are you still watching the headlines? Because that answer will define everything that happens next for your financial future. Stay sharp, stay informed, and we will see you in the next one.